So we've been getting a lot more questions on it. We've done some episodes on it, but clearly not as deep into the data and the weeds as your two recent, or not the two recent, but two very recent videos that you did on the subject. So can you go over some of your findings of benchmarking covered call index ETF versus the same index ETF, but some cash as well? And just understand and explain the logic behind that, because I think some who invest in covered call index ETFs do it as kind of mental gymnastics, of lack of better word, because they don't have to sell the actual shares in the ETFs. They can just collect the income and live off of that.
Yeah. So I think that there is a lot of mental gymnastics or mental accounting that goes on with covered call funds. What I did for the recent couple of videos is I compared the performance, the total return performance of covered call ETFs to ETFs that simply invest in the same underlying assets as the covered call fund, but don't have covered calls, like just a regular index ETF. There are a bunch of funds from BMO and some from Global X that have pretty long histories. And I want to be clear, like there's nothing necessarily wrong with these products. There's nothing necessarily wrong with the concept of covered calls as an investment strategy. I think the problem that I have with them is the way that they are marketed and sold, and the way that investors interpret what they're getting from them. I think that's where all of the errors are happening. I'm not like, if someone wants to do this and fully understands the implications and fully understands what they're doing, that's fine. And maybe some institutional manager does this for some specific reason that makes sense for their institution. But I think retail investors are being misled really in what these things accomplish. So what I did is I took covered call funds that invest in whatever, say S&P TSX index and write covered calls, and I compared that to an ETF that just invests in the S&P TSX. And I just said, which one has better performance? And what I found is that when you look over any meaningfully long period of time, most of the time, the covered call funds have underperformed. Now, that should not be surprising to anyone who understands what is happening with a covered call, because covered calls are reducing your exposure to the underlying equity. So if we believe that stocks or an index or whatever has positive expected returns, you should expect to earn lower returns by writing covered calls, because you're effectively shorting exposure to the equity by writing the call option on it. So you're reducing your exposure to the equity. So one of the things that I did to your question is I took 5 funds that had at least 10 years of history, and I picked a 10-year time period, 10 years ending, whatever, probably September 2025. And I just compared their 10-year outcomes, covered call funds, all of them underperformed. And then to address a common question about covered calls, I looked at a withdrawal scenario. So I said, okay, we're going to spend the distributions from the covered call fund, and we're going to see and spend the exact same dollar amount from the underlying equity. And we're going to see if that magically makes covered call funds better. It does not, which I was not surprised by, but I think a lot of people believe that somehow.
I was not either.
Right.
No,
you shouldn't,
yeah,
that nobody should be. But you said it earlier. You don't have to sell shares, and that makes people think that somehow you're going to be better off with the covered call fund than with the underlying if you need the income. Anyway, so covered call funds underperform even when you had to do withdrawals. And then the other thing that I thought was interesting is I thought, okay, if covered calls reduce exposure to the underlying equity, and we know they're underperforming, there's probably some allocation to cash and the underlying, so some mix between cash and the underlying equities that ends up giving you a pretty similar result to covered calls. So I looked at that for the 5 funds that I had in my model, and I found that on average it was about 26% high interest savings account allocation that gives you a similar result. So that for those 5 pairs of funds, on average, I had to allocate 26% to a high interest savings account, 26% to the underlying equity, to get the same result over 10 years as investing in the covered call for that same equity.
You could probably even lower that a tiny bit if you use something like treasury bills, right? That are high liquidity and tends to yield a little higher than high interest savings accounts.
Yeah, you probably could. Yeah.
Yeah.
Yeah. So I thought that was interesting, because it's like, I think if you told most people that a covered call is like investing 25% of your portfolio in cash in high interest savings, I think most people recognize that's probably going to lower your expected returns. But then there's this disconnect where covered calls are magically perceived as not lowering your expected returns, but I don't think that's the right way to think about it.
Yeah, I mean, is it just because it's easy? Maybe it's just that it's very easy for people to just collect the income they get from these covered calls versus having a plan and having some cash aside to minimize the sequence of return risk. Is it just that simple?
So I don't think it does minimize sequence of returns risk. I think that's another perception that's wrong. I think it. I don't
No,
know.
I mean to have cash minimize that so you can rely on your cash to get those withdrawals is what I was
Oh
getting
yeah,
at.
okay,
Yeah,
okay,
yeah. Mhm.
yeah. I mean, even the cash, I don't think that helps with sequence of returns risk either. That's another interesting one where it's like when you look at for long-term investors, does holding a big chunk of cash help? And it doesn't. It makes you a little bit worse off, which is counterintuitive. But it lowers your expected returns and enough that even though sequence of returns can be an issue, holding cash still doesn't help much. Anyway, on covered calls, is it the ease of it all? I think that's a big part of it, where it is hard to figure out how much you can withdraw from a portfolio. That's like a truly hard problem. I don't think that covered calls solve that problem, but I think that they give the perception that it has been solved because you're getting this money deposited into your bank account or into your investment account. And it's like, hey, this money arrived here. It must be okay for me to spend it. And that does matter to some people. And not having to think about how much to sell or go through the actual process of doing a sale and maybe having to think about taxes and transaction costs and all that stuff. Those are all real frictions. And I do think that's one of the attractions that people have to covered calls.
Yeah, and why do you think? Because one of the things you mentioned a few times in your videos, obviously you're capping your upside with covered call ETFs. So that's pretty, to me, it's pretty easy to understand, right? You cap your upside to essentially the strike price plus whatever the premium that you got. But it seems like it's something that there's a lot of difficulty understanding, and then they just automatically think that you're also going to have a lot less downside associated with that. And sure, you're going to have a little less downside, essentially the premium that you got in exchange for it. But it's kind of not a fair trade-off if you're asking me, and you definitely demonstrated that. So why do you think a lot of investors have that trouble understanding that trade-off that you're doing, and it's not really a very fair trade-off when you think about it, especially when markets tend to go up over long periods of time, not down?
I mean, it's yeah, fair is a tough one here because it should be fair, right? The way that options are priced, you should be getting enough premium to compensate for the lost upside when you take into account the fact that you're lowering your beta, your exposure to the equity. But I don't know. When you think about the way that returns matter for long-term investors, those upside returns matter a lot. The fact that there's been some mean reversion historically in stock returns matters a lot. And I think that you make that go away with covered calls. So I don't know. I mean, there's an interesting question there of who are options priced fairly for, and maybe for long-term investors who care about those things, maybe you could say they're not priced fairly. But fairness aside and efficient pricing of options aside, I think that the big problem with asymmetry is what you said. It's that it eliminates the right tail of the distribution of stock returns. Like if we think about stock returns as a normal distribution, which they're not normally distributed, but just as a simple model, we think about them as normally distributed. So that means you've got some really, really good returns, sometimes some really bad returns, sometimes most returns are concentrated around whatever the average that we expect. So there's this normal distribution. When you're doing covered calls, you're cutting off the right tail of the distribution, and that right tail matters a lot. Period. Like that matters a lot for long-term investors, but it matters extra a lot when you consider the mean reversion aspect of it, because when markets drop, typically what happens is you've got positive returns after that. That's not a guarantee. Stocks don't always go up. However, when you look in historical data from stock markets all around the world, going back as far as we have data, what tends to happen after crashes is recoveries. And there's, probably survivor bias in there, and the fact that we've existed with this system as long as we have. So that's going to look that way. But in any case, with covered calls, you're eliminating that. So when you have a crash on the subsequent recovery, you're not going to participate, which I think makes stocks riskier for long-term investors than they are when you have the mean reversion working in your favor. So that's all problematic. I don't think that investors are trained to recognize the effects of asymmetry. And I guess I didn't really mention on the downside with covered calls. So your upside is capped because of the way that writing the option works. The downside, stocks drop. You have a little bit of a buffer because you are getting option premiums that the underlying is not getting, but it's a small buffer. Like if stocks drop 40%, you might get 5% less of a drop or something like that, because option premiums might go up in a high volatility period, but it's not going to protect you as much as you're going to give up on the upside. So not great. And investors are trained to think about risk as volatility and to think about Sharpe ratios. None of those metrics account for the asymmetry that gets introduced with options. So I think it messes with people's mental model of what is risk, what is a risk-adjusted return. And this is something that in academia, it's been recognized since probably the early 2000s. There's some big papers, highly cited papers, talking about how you need different risk measures when you introduce options because of the asymmetry. But I don't think that's largely filtered into retail investor circles. So I don't think it's well understood. I don't think investors are trained to look for asymmetry. And I think it's one of the biggest problems with covered calls for long-term investors.
If you'd like to listen to the full episode, head to your favorite podcast player and type in the Canadian Investor Podcast. If you'd like to watch the full video, go to jointci.com and you'll be able to subscribe to our Patreon page. On top of that, you will get the podcast feed ad-free. You'll also get our monthly portfolio update and my parents' retirement portfolio update, which I manage myself.